You just spent $680 million to buy your very own bank. The wire transfer clears at 9:04 in the morning, and just like that, you're a banker. You now own 45 branches, thousands of vaults, and the trust of nearly 300,000 depositors. But here's the part nobody warns you about. You haven't earned a single dollar yet. Before your first customer walks in tomorrow, you already owe regulators paperwork and lawyers their fees. Somewhere in your new headquarters, a compliance officer is already building a list of everything that could go wrong. You expected to feel like a tycoon. Instead, you feel like you just adopted a very expensive, very nervous animal. Every dollar sitting in your vaults isn't really yours. It belongs to people who can ask for it back at any time. That single fact is the entire business model, and also the single biggest risk you now carry. So what does it actually take to own, run, and survive owning a bank? Let's find out. A bank isn't really a building full of cash. It's a license to hold other people's money and lend most of it back out. Every bank exists because of one core idea. People need somewhere safe to keep money, and businesses need somewhere to borrow it. Your new bank has a charter, a government-issued permission slip that allows it to legally accept deposits. Without that charter, none of your 45 branches are worth anything. They're just office buildings with fancy vaults. Depositors are the regular people and businesses parking their paychecks and payrolls inside your walls. Borrowers are the other side of your business. Homeowners, small business owners, and companies taking out loans. The gap between what you pay depositors and what you charge borrowers is called your net interest margin, and it's how banks actually make money. Your bank also owns something invisible but priceless. Decades of trust built by the previous owners. That trust took 50 years to build, and it can disappear in a single bad news cycle. Your branches aren't just retail space. They're regulated fortresses with vaults, cameras, alarms, and armored trucks. Behind every teller window sits a mountain of software tracking every transaction in real time. In short, you didn't just buy a business, you bought a promise to hundreds of thousands of people. The $680 million purchase price covers the bank's branches, its loan portfolio, and its existing deposit base. On top of that, plan for another $40 million in legal fees, regulatory filings, and due diligence. Federal and state regulators need to approve you personally before the deal can even close. That approval process alone can take 6 to 12 months and involves background checks most people never imagine. You'll also need to inject fresh capital, roughly $85 million, just to meet minimum capital reserve requirements. Every bank must hold a cushion of capital in case loans go bad, and regulators check that cushion constantly. Your 45 branches come with real estate costs too. Some owned outright, some leased for $12,000 to $40,000 a month each. Then there's technology. Core banking software licensing alone can cost $15 million a year to operate. Insurance for a bank isn't optional, and premiums for fraud and cyber coverage alone can reach $6 million annually. You'll also inherit existing employee contracts, pension obligations, and severance agreements from day one. Working capital to cover the first 90 days of operations adds another $25 million to your total bill. By the time the ink dries, your $680 million purchase has quietly become an $850 million commitment. Your first morning as a bank owner starts at 6:30 a.m., an hour before any branch opens its doors. Armored trucks are already delivering cash reserves to your vaults under armed escort. Branch managers are running mandatory security checks, testing alarms, cameras, and vault time locks. 900 employees show up expecting paychecks, benefits, and stability, all suddenly your responsibility. Your IT team is monitoring millions of overnight transactions that processed while you slept. At 9 a.m. sharp, your first branch doors unlock, and your first customers walk in. A small business owner is here to deposit yesterday's earnings, unaware the bank has new ownership. A young couple sits down with a loan officer, hoping to qualify for their very first mortgage. By noon, a wire transfer error in one branch triggers your first real crisis of the day. Nothing was actually lost, but a call to your compliance officer costs you 3 stressful hours. Your first customer complaint arrives before lunch, about a fee nobody explained clearly enough. By day's end, your bank processed 12,000 transactions, and you didn't personally see a single one. Your bank makes money almost entirely on the difference between 2 interest rates. You pay depositors around 2% interest to keep their money with you. You then lend that same money out as mortgages and business loans at 7% interest. That 5% gap, multiplied across billions of dollars, is your core profit engine. Last year, Your new bank earned roughly $410 million in total interest income, but interest paid to depositors alone cost the bank close to $140 million. Payroll for your 900 employees runs about $95 million a year, including benefits. Branch rent, utilities, and maintenance across 45 locations cost another $28 million annually. Technology, cybersecurity, and core banking software eat up $35 million a year. Deposit insurance premiums paid to protect customer funds cost roughly $9 million annually. Loan losses, money borrowers simply never pay back, average $22 million a year. Legal and regulatory compliance staff alone cost you $18 million annually just to stay licensed. Marketing to attract new depositors and borrowers adds another $6 million a year. After every expense is paid, your bank nets around $95 million in annual profit. That sounds impressive until you remember you spent $850 million just to get here. At that pace, it takes almost 9 years just to earn back your original investment. And that's assuming nothing goes wrong, which in banking is never a safe assumption. Interest rates are your biggest enemy, because when they shift, your entire profit margin shifts with them. If the central bank raises rates suddenly, your cost of holding deposits can spike overnight. A single large borrower defaulting on a $50 million loan can wipe out a full year of profit. Cybercriminals target banks constantly, and one successful breach could cost you tens of millions in damages and lawsuits. Regulators can fine you millions for a single compliance failure, even an accidental one. A recession doesn't just slow your growth, it can trigger a wave of loan defaults all at once. Younger customers increasingly prefer fully digital banks, threatening your traditional branch-heavy business model. Keeping experienced loan officers and branch managers requires constant competition with rival banks for talent. One viral rumor about your bank's stability, even a false one, can trigger a run on deposits. Aging bank branches require constant renovation just to keep up with safety and accessibility codes. Fraud attempts hit your branches daily, from fake checks to stolen identities. Most new bank owners underestimate just how much regulation touches every single decision they make. So after $850 million, 9 years to break even, and constant regulatory pressure, is owning a bank actually worth it? If you have deep pockets, patience, and a genuine passion for finance, the answer can be yes. Banks are one of the few businesses that profit even in a slow economy, as long as they're managed carefully. But if you're looking for fast profits or an easy business to run, a bank is the wrong choice entirely. This isn't a business you buy and walk away from. It demands constant attention every single day. The safest banks aren't the ones with the fanciest branches. They're the ones with the most disciplined risk managers. Your vaults might hold the cash, but your risk officers hold the actual future of the business. Owning a bank means owning other people's trust before you ever own your own profit. The building isn't your biggest asset. The depositor's confidence in you is. Buying the bank was the easy part. Keeping it trusted for the next 50 years is the real job.